So welcome to our webinar this morning. I'm Terry Finisterre, of course, Communications and Member Relations Officer for the Caribbean Association of Banks, Inc. I'm happy to introduce to you our friends from S&P Global Market Intelligence, specifically Ina Popescu, who's going to be taking us through this morning. She's the Associate Director at S&P Global Market Intelligence. And thank you very much, Ina, for joining us this morning. During our 45-minute Breakfast and Learn webinar, we'll be addressing some of the key issues related to the effective implementation of IFRS 9 as the International Financial Reporting Standard, with special emphasis on impairment calculations for financial institutions in Latin America and the Caribbean. Now, throughout the course of the morning, you can, of course, submit your questions. You can submit your questions using the Q&A, as several of you have already done, or you can do so on our YouTube channel as well, and I will direct them to Ina. Please note that this is being recorded and is on demand, so that's going to be on our YouTube channel, as I said earlier. You can also request more information by accessing the link that will be placed on the chat during the whole presentation. So we're going to get started this morning with a poll question, as I indicated, to kick off our discussion. And then I am going to hand over to Ina, who is going to get us started. So here's our poll question. It's running, so please go ahead and answer the poll. We have 77 people on so far. And I will now hand you over to Ina Popescu. Good morning, Ina, and the floor is yours.
Good morning, Terry, and thank you for inviting us to present during the webinar for your audience. So I can see that we are currently going through the poll, and quite a few of you are participating. So I will give you a chance in the next 10 seconds to cast your votes for different options that you have here in front of you on the screen, and then we will look at the results of the poll, and then we will kick off with the webinar itself. Okay, so let's look at the poll results. As you can see, our question was, as part of your internal process, do you currently consider the impact of macroeconomic factors on expected credit loss calculations? We have 26% of attendees that replied that they are considering it primarily in probability of default side. We have 69% of the attendees that responded that they will equally emphasize the impact of macroeconomic factors on probability of default and loss given default. And we have some percentage of attendees that don't consider those factors. It's actually a result that we would expect from the audience, because indeed in recent years, with IFRS 9, there was much more impact and much more emphasis put on macroeconomic factors, and they are important for the both PD and LGD calculations, but not all market participants consider those. This becomes quite important in the light of IFRS 9, and that's why we wanted to have this quick poll before we start. Now, without further ado, what we will do now, we will go through the presentation itself. So the agenda for this morning is to look at three key components. So first, we will start by looking at key issues and considerations that you need to be aware of when looking at IFRS 9 credit impairment calculation. After that, we will discuss, based on S&P Global Market Intelligence risk solution experience, what is our recommended approach for expected credit loss calculations under IFRS 9. And lastly, we will look at the practical example, how to put together all the required components in order to arrive to ECL calculation. And then lastly, as Terry indicated, we will be taking some live questions. Now, without further ado, let's start with first element. which is key issues and considerations that you need to be aware of when looking at IFRS 9 credit impairments. Now, I guess when it comes to ECL calculation, in theory, the formula is very simple. You need to know your probability of default, your loss given default, and your exposure default. And once you have all those three components, you will be able to calculate your ECL or your provisioning. Now, in practice, it's a little more complex because there's various aspects that you need to consider as part of the formula. So from one side, you need to ensure that you include macroeconomic indicators as part of both your PD and your LGD calculations. You need to consider the structure of your entity under analysis. You need to consider the ownership of that entity. You need to consider instrument-specific characteristics such as collateral that might be pledged towards your instrument, its hierarchy within that waterfall, and also other elements that go beyond the calculation itself and that look at aspects like staging criteria and what is your internal process and your internal view to those staging definitions. Because as you know, according to IFRS 9, this should be your internal decision. Now, as you can see, in theory and the praxis are the same, but in practice they're not, as Albert Einstein said. So let's look at those elements that are required and what we know that will impact your ECL calculations. Now, first of all, I wanted to highlight that right now we are talking about low default portfolios. So obviously, when it comes to low default portfolios, there's quite a few issues that might be relevant for you and you need to be aware of. So first of all, the asset class itself. So there's not that many defaults, so it might be a bit trickier to get the data, relevant data for your ECL calculation. The second biggest block that I touched upon earlier as well is the staging. Because as you know, as part of IFRS 9 calculation of provisioning, you will now need to classify all your counterparties into three buckets or three stages. So bucket one or stage one is reserved for those counterparty which maintain their credit quality throughout the year, and it doesn't exhibit what is called significant deterioration in their credit quality. Now, the bucket two or stage two is those counterparties that have seen significant deterioration in their credit quality. And bucket three is reserved to those counterparties that went into the default stage. So we will focus right now a little bit more on the difference between stage one and stage two. And primarily, the question here is, what is your internal definition or how you define this significant deterioration in credit quality? And at this point, the decision has to be your internal decision, but you have different ways how you can look at it. From one angle, you can look at the credit quality itself. So how your counterparty moved through the ranking of credit quality assessment that you have done internally. From the other side, you can look at the numerical PD associated with that credit quality and see the impact on the actual figures that the change in the credit quality had. And by looking at this change, identify whether that change in the credit quality was significant and qualifies the entity to go into stage two. Now you can do it as a blanket approach across the whole sector or segment or scale, or you can do a more detailed approach by differentiating the way you look at it. So for example, having slightly different view on those counterparties that are investment grade and having a different staging approach for those that are sub-investment grade. So ultimately the decision is yours, but you have different ways how you can arrive to it. Now, the last point I wanted to make on this slide that for the purposes of IFRS 9, there's three key concepts that are very important. One is you need to obtain unbiased, probability-weighted ECL reflecting a range of possible outcomes. You need to consider the time value of money concept, and you need to have access to reasonable and supportable information that will allow you to include or analyze the past events, current condition, and forecast of future economic conditions. Now, we've all been working with those concepts of PD and LGD in the past, and in the context of Basel II, I guess majority of you are already familiar with the concepts. But what actually is different with the introduction of IFRS 9? So what are components that are still working? What are those that require different angle through which you need to look at them? So first of all, let's look at the probability of default. Now, from a regulatory point of view, we are looking at through the cycle PDs, while for IFRS 9 purposes, you need to look at point-in-time PDs. Now, the time horizon is different as well. So when for regulatory purposes, you were using 12 months. Now, for IFRS 9, depending on your classification, whether the entity is in stage 1 or stage 2, you need to look either at 12 months or at lifetime PDs. Now, lastly on this point, I want to mention that it is quite relevant for IFRS 9 to have an unbiased and forward-looking view on your point-in-time PDs, and that's why you need to include the macroeconomic forecast as part of your PD calculation, which is slightly different from the approach that was taken on the regulatory front, where you would consider only the worst-case scenario, downturn PDs. So that was with regards to the PDs. Now, on the LGD front, this is where the discussion becomes even more interesting. Because in the past, under Basel, you had an option either to have your internal model to derive your LGD estimates, or you had a possibility to use a regulatory prescribed LGD figure. Now, under IFRS 9, approach, you will no longer be able to do this. You will need to have an estimate that are unbiased, forward-looking, and instrument-specific. Therefore, just by looking at one figure that is a downturn figure, you are moving away from this unbiased view. So you need to introduce it to your approach if you haven't done so already. I guess when it comes to the local considerations for the Latin America and Caribbean market, similar to other regions, you would expect a few trends that I will be mentioning right now. So first of all, the fact that the level of local or regulatory endorsement will be slightly different depending on the country in which you operate. You need to consider your internal capabilities. This is important because we are looking at macroeconomic forecasts. So some of you might have an in-house economic unit that can produce those forecasts, but some of you might rely on the third data providers for that information. You definitely need to consider your portfolio-specific characteristics as part of your process. The good thing is that similarly to the Basel, if you don't have internal capabilities to arrive to PD figures or LGD figures, you can rely on the third-party data providers to help you in this process. However, you need to ensure the consistency in the approach, which means that there should be a consistency between the PD and the approach that was used to arrive to that credit quality associated with the PD. Lastly, you need to ensure that whatever model you take into consideration is not only reflecting historical, systematic and macroeconomic data, but it's also validated and backtested or benchmarked in order to ensure that you get a comfort around the tool that you're using for the ECL calculation, because they have a direct impact on the provisioning that you need to set aside. Now, let's talk a little bit more about S&P Global Market Intelligence experience and approach on ECL calculations. Now, as I mentioned, when it comes to expected credit losses, the process is quite straightforward. You need exposure at default, you need your loss given default, and you need to have a figure for your point in time probability of default. Now, with exposure at default, this topic is quite straightforward. This is something that you have on your books. You know exactly the exposures that you have with different companies or different entities, and the value of that exposure. Now, where you might need to have a little bit more help or thought is on LGD calculations, if you don't have already an internal tool that can address those issues, and point-in-time PDs. Now, we've done the research on how to rise to point-in-time PDs a couple of years back when IFRS 9 topic was very topical, when they just introduced the standards and they just made an announcement. So we actually realized that the process that you can take is quite straightforward. So one, you need to derive your credit quality of your counterparty. And second, you can map it to the numerical PD. So this is something that you would traditionally do under the Basel, but then you can find a way how to transfer the through the cycle PDs into point-in-time PDs. So we've actually done it through the approach that I will tell you in a bit more details in a minute, but essentially it takes into consideration what we call annual adjustment factor that allows you to convert through the cycle PDs into point-in-time PDs. So let's look at each step one by one. So first step is credit quality indicators. Now, with regards to the credit quality indicator, it obviously depends on your portfolio composition. You might have some exposure to rated universe, in which case you might be potentially relying on the third-party credit rating. You might have a situation where you have a blend of exposures, which are both rated and unrated, or you might have a situation where your whole of your portfolio is unrated, in which case you need to make sure that you have an in-house tools that help you to arrive to those credit quality estimates. Now, those credit quality estimates need to be sector specific. They should include those drivers, both from qualitative point of view, but also from quantitative point of view. They should look at the relevant ratio and relevant benchmarks in order to ensure that you arrive to a credit quality estimate that is comparable across all the sectors. Now, at S&P Global Market Intelligence Risk Solutions, we've been working in this sector and with clients that were focusing on unrated universe for over 20 years. And we've designed the models with those clients in mind. So those are models are plug-and-play solution, transparent glass box solutions that are targeting in different ways and by looking at different combination of qualitative and quantitative factors at different sectors. So obviously, when IFRS 9 topic came in place, we had a look at the requirements and we had a look at our experience. And right now, what I want to show you, I want to walk you through the experience and approach that we believe is important, and hopefully it will resonate with some of you, or maybe it will give some ideas to you how you can look at your internal models. So right now, what you see in front of you is an example of our generic corporate scorecard. Now, in the approach that we see fit for our clients that use the models for various purposes, including IFRS 9, and that it's very important to ensure that your models take into consideration the country in which the entity operates, as well as the industry in which it operates, that those models adapt towards the profile of your industry, in which your entity operates through both weights, but also through the benchmarks that are used in financial calculations. So as you can see, we would recommend to look at macroeconomic factors and then look at the entity-specific factors. Now, this approach allows you to consider both quantitative and qualitative elements. At this point, what becomes quite essential is that within the organization, you apply a similar approach for assessment of qualitative factors. So there's no discrepancy in the way different analysts look at the entity itself. In order to do this, it becomes very important to have a detailed, well-written qualitative guidelines that sets frame to what approach the analysts need to take. These models should take into consideration not only historical information, but they should also allow you to reflect your forward-looking knowledge of the entity from qualitative, but also from quantitative point of view. And here, obviously, I have a demonstration for you how it can be done. Now, the next step would be to map this credit quality to the numerical point-in-time PDs. So back in the day, a couple of years ago, we sat down and we decided to think about what is that we know about probability of defaults and through the cycle defaults in particular, and how we can use that experience in order to move or to arrive to point-in-time PDs. The reason we selected this approach is we know, and I guess we all agree that we are very comfortable with the through the cycle PDs approach and how they derive, because they were in use for an extensive amount of time. Therefore, using it as a base would all give us all a comfort. So what we did, we actually look at the trend in through the cycle PDs versus a trend for the observed default rates, or from historical point of view, your point-in-time PDs. And what we realized is that both through the cycle PDs and point-in-time PDs, they tend to follow the same path. But what will differ is the magnitude of the jump that you will observe in different curves. So this gave us a comfort that indeed we can use through the cycle PDs, and we base our approach and our view how to move from through the cycle PDs to point in time on this approach. And you can see the illustration of it on the slide. So essentially here, the red line is our through the cycle PDs, and the blue line is our point in time PDs. So as I mentioned, in order to shift the curve from through the cycle to point in time, we will look at annual adjustment factor. So what we mean by annual adjustment factor and how it actually plays a role. So we looked at various elements that can explain this magnitude of the jump. And we narrowed them down to three big blocks. First block of factors, there are those factors that impact the global economy. So this can be, for example, your change in non-energy index. The second block of factors are country specific. So this is your GDP growth and change in unemployment. And the last block of factors is your institution specific factors. So what we're looking here at is the percentage of the downgrade this year versus last year. And why it's important? It's important because originally, when you decided to work with your counterparties, you already had some view on their credit quality and how they will look like in the future. So by looking at these three key blocks of factors, we can arrive to annual adjustment factor that can shift through the cycle PDs into point-in-time PDs. Now, one thing to mention here is that obviously, when it comes to the through the cycle PDs, AAA. But when it comes to the point-in-time PDs, we do make a difference, and we do see that the speed through which different entities in different sector operates will be different. So in order to reflect the different speed in the way they go through cycle, we recommend to have different annual adjustment factor when you're looking at FIs versus when you're looking at corporates versus when you're looking at specialized lending. So essentially, using this approach, you can arrive to a point-in-time PDs. Now, lastly, I want to spend a little bit more time on loss given default. Why specifically I want to spend a little bit more time on this topic? Well, because traditionally, this topic was a little bit overlooked due to the availability of lookup tables and possibility to use the averages figures. Now, back in the day, for over 20 years ago, what we decided to do, we decided to actually look at the instrument-specific LGDs and follow the process of recovery to understand how we can explain and how we can follow the process of recovery in order to arrive to instrument-specific loss given default. And bear in mind that we are talking about a low default portfolio, which means that it might be hard to build a model and then test it on the independent sample. Now, using our internal capabilities, we built the model and we have obviously back tested it. I presented here on the slide some results of a back testing exercise. But the main reason I actually put them there is to illustrate to you that indeed, depending on the instrument, depending on the company, you might have different recoveries. It can go all the way from 0 to 10 bucket to 90 to 100 bucket. Why it's important in context of IFRS 9? It's important because if you were to use a more simplistic approach, you might run into a risk that you are either overestimated or underestimating risk. And given the fact that this particular element directly impacts the formula for your provisioning calculation, it's quite important to get it right. I have here a little bit more details on our approach and the way we look at it. So I hope this will be useful for you. So when we look at the point-in-time LGD estimates, I guess no one will argue that in theory, the approach is quite straightforward. You need to know your exposure at default, so your instrument value, and you need to know economic value at default. So the value after which you can go and the one that will be used to repay on your instrument. Now, in practice, it's a little bit more complex than that. So first of all, you need to look at the economic value as of today, and the way you arrive to economic value can be different and should be different when you look at the corporates or when you're looking at the bank, or when you're looking at the project finance. So for example, when you look at the project finance, you will look at the cash flows of the project, or when you're looking at the bank, you can look at things like what we call traditionally banking and trading book. But regardless how you arrive to economic value, as of today, you need to consider the impact that this economic value can go through due to the changes that entity will go throughout the year. So our time horizon that we assume here is 1 year, that allows you to assess it in the spirit of IFRS 9 forward-lookiness. So we recognize this economic value will not be static, so we apply the volatility and we see how the economic value will change in the next day, 2 days, or all the way to 365 days from now. Then we look at what we call path to default in order to understand how the economic value that the entity has today will change and by how much we should stress it in order to bring the entity to the default state. And then last but not least, we would look at what we call bank policy. So we have different options here. For example, we have going concern, where you essentially say that your entity defaulted on an instrument, but it's still going and operating, so there's some more value creation inside. Or you might say that it's going to liquidation. So the snapshot that we took as of today, economic value at default, will be the pool to which you will have access to. So this is from the point of view of economic value at default. Now, after that, what we need to understand for your instrument, what is exactly the position within that waterfall? And as you appreciate, depending on the instrument you have, they might be classified senior or they might be classified as subordinate. There might be some isoline items that will be repaid ahead of you, even if you are senior creditors. So, for example, it can be taxes or salary obligations or pension obligations. And again, depending on the jurisdiction in which your company operates, some of those line items might be treated ahead of you as a senior creditors, and some might be treated pari passu. And that's why it's very important to consider seniority of your instrument. Now, in addition to that, we need to consider the time value of money concept. That's why we look at the insolvency regime score. And also, it's important to consider those factors that can improve the recovery and can act as recovery enhancement. So what are those factors? From one side, it's collateral that is pledged towards your instrument. So we can look at the value of that collateral, but also the type of that collateral, as well as any collateral that is pledged towards your instrument, towards the instruments that are ranked pari passu to your instrument. And from the other side, it can be any guarantee that can act as a recovery enhancement that are coming from a good credit quality counterparty that can be used towards your recoveries. And then lastly, you need to obviously consider recovery costs, so all those administrative costs that you need to bear as an institution in order to go through this process and obtain your recovery or loss given default on your instruments. So all those elements are quite crucial. All of them will play a role in order to arrive to a loss given default that is instrument specific and will ensure that you can get the ECL calculations that are relevant for your exposures. So step 4 will be just to bring all those components together, and I have here more visualized way of putting them together. So as you can see, step 1 would be to arrive to credit quality indicators, either using your internal models, using third-party ratings, or by acquiring a third-party solution, then mapping that credit quality to a point-in-time PDs, depending on the approach that you take internally. This will allow you to arrive to the first component of the assessment, which is your point-in-time PDs. Then we will need to look at the instrument-specific LGDs combined with your exposure at default, and then calculate the ECLs. And this is the point where you will need to make a decision whether you are looking at stage 1 instrument or stage 2, and whether and how you use and how you define the difference between stage 1 and stage 2, so the difference in through your definition of significant deterioration in credit quality that can be achieved through different means. So that concluded our experience and our approach on calculation of of ECL calculation. And now let's look at the example on how to combine those figures and how to calculate ECLs. So first of all, you need to look at the entity that you have under consideration. So just for example purposes, let's assume that you have an entity that is a corporate that operates in the regions, let's say in Bermuda, and that is focusing on equipment rental. Now, obviously, after you have identified and you know which counterparty you're looking at, you need to understand for which facility you're calculating the ECLs. So once you have this clarity, the first step would be to determine the credit quality. And as I mentioned, there's various ways of doing it. So let's assume that this is the credit quality of that particular counterparty under assessment. Then next, what you need to do, you need to reflect the macroeconomic forecasts in order to arrive to point-in-time PDs, and those point-in-time PDs should be country and industry specific. So right now in front of you, you have an example based on those forecasts for Bermuda, and assuming that you're looking at the corporate company, what would be your point-in-time PDs? However, those figures would differ if you were to look at FI sector within same country, or if you were to look at corporate sector in different country. So let's assume this is the PDs that we will take for the ECL calculations. Now, the step 3 would be to look at the loss given default calculations, as you already know by now. So in order to do this, I have here an example based on S&P Global Market Intelligence Risk Solutions LGD model, how you can look at LGD figures. And here, I guess it's quite important to mention a couple of things that your LGD estimates needs to take into account sector in which your entity operates, because volatility of economic value depending on the sector will differ. You need to consider country in which your entity operates, because insolvency regimes in different countries, in different regions differ, and they will have an impact on your LGD calculations, because in different countries you will have to expect different timing to recover your funds. And then obviously it's important to know what type of instrument you have. So whether you're looking at secured or unsecured notes. So here, just for the illustration purposes, let's assume you're looking at unsecured note with some other senior creditors having some collateral pledged to them. So they're on the same seniority level, but the collateral is pledged to them and not to you. So at this point, you can arrive to the LGD estimate, but as you would expect for IFRS 9 purposes, you need to look at this unbiased view. So we have here illustrated how you can arrive to different LGD estimates in order to later weight them according to your expectations and use that final weighted average LGD in your formula. So let's just have a look how all this information is coming together. So as you can see, you need to know your point-in-time PD, you need to know your exposure default, you need to consider your effective interest rate as part of the calculation in order to capture the impact of discounted cash flows as part of ECL. And depending on the staging, whether you need to look at 12 months PD ECL or lifetime ECL, you can see the impact the dollar impact that you might expect to see. I guess at this point, I just wanted to highlight a couple of things. It's very important that as part of your ECL calculation, you have a model or a series of models that you use that you are very comfortable with. They should be transparent and fully auditable, so you have really good understanding on how you arrive to the different components, especially if you're using third-party solutions. It's quite important the way you define your staging criteria, because all of these components can have and will have a direct impact on your provisioning. And bear in mind that right here you have an example of one instrument, but in reality, in your portfolio, you will have exposure to various instruments, and even within the same counterparties, you can have a couple of instruments that you're exposed to. And that's why it's important to have a good understanding on the approach and also to consider macroeconomic factors. So going back to our poll question. I guess at this point, I just wanted to mention that obviously if you are looking for a solution that can help you with any parts of the process, we do have some models that we've designed and that have been used by various institutions globally, including for IFRS 9 purposes. So if you're interested in hearing about them, please let us know, and we'll be happy to address your questions on IFRS 9 topics, as well as discuss with you how we can help you. So I guess we can pause here and look at the questions that have arrived throughout the presentation.
Right. Thank you very much for that presentation, Ina. I'm sure it would have been very, very well received by our participants. We are actually at our limits on the Zoom platform, and we have a number of people as well on our Facebook channel watching the presentation. So we don't have any questions in the Q&A, but we would be happy to take them at this time. If you have any specific questions for Ina, please address them to her at this time. Ina, one of the things I would like to address, like you to address, can you elaborate on COVID-19 government emergency financing and support on PIT/PDs in particular when it comes to unrated universe?
Sure, thank you, Terry. It's a very good question, and in the past year we've been getting this question quite a lot. Mm-hmm. So I'm not surprised to hear it right now. Indeed, in the past year there was quite an unprecedented amount of support from the government that came directly to market participants, and multiple organizations that were mentioning that there is a need to capture it in the ECL calculations themselves. So there was various places where you can consider the impact of those government support and government packages in the ECL calculations. So first of all is by looking at the forecasts that are used as part of ECL calculations themselves. So various economists globally have proactively adjusted their forecasts in the past year, and still looking at it now in order to determine the bounce back and the impact of that support. So that would be the first element that you can consider, or the participant here can consider as part of their approach. A second point is the direct impact that those government supports have on individual entities. So this is something that can be considered as part of credit quality estimates. And I guess the last point that I can mention, it doesn't directly impact point-in-time PDs, but it is still related to that. Is a question of staging. So again, as you define the significant deterioration of the credit quality of your counterparties, you need to understand how those packages will play out, and therefore impact the staging definition that you apply within your organization.
We have a couple of questions coming in already on the platform. With regards to macroeconomic factors, how can one determine the value percentage to be applied? Won't this be subjective? That's coming from Janelle Alexander.
Okay. So thank you so much for the question. It is definitely an important question with regards to macroeconomic factors in general, how to define the value impact. I guess there's different ways how you can look at that. So for example, within your PD calculations, or with the first step would be to look at the credit quality of your counterparty. So when you're looking at credit quality of your counterparty, you can consider within your approach the impact of macroeconomic factors on your entity under assessment. Now, at S&P Global Market Intelligence Risk Solutions, we do have various models and various approaches on how you can look at it. And it depends on the sector in which your entity operates. So in some cases, for example, when you're looking at banks, it might be the starting point of your assessment, while for corporates, the macroeconomic environment might be one of the components that you look at. So this will be one element to consider, so directly as part of your credit quality estimate. Additionally, when you look at your loss given default estimates, again, next part of the formula, you can also consider the macroeconomic factors, so your economic expectations based on the change in macroeconomic environment in order to arrive to those LGD estimates. Now this brings a whole new topic to mind, is how you define your macroeconomic scenarios and what is the views that you are taking, because as you know, for IFRS 9 purposes, you need to have this unbiased view, and you shouldn't really rely on a third party to provide you with those weightings and information on what the global economy will look like and how macroeconomic factors will look like. It should be defined by you, and this is a requirement, obviously, from IFRS 9 point of view. You should make sure that whatever approach you're using internally for your provisioning allows you to reflect that factor. Obviously, there's some trends that you can follow in the general views that you can look at, but I would say these are the key elements and key places where you need to consider those factors. And obviously, if you're interested in having more detailed discussion on this, let us know.
Right. We have another question. Thanks for that very detailed answer. How does the new standard cater to the inherent risk in the agri sector?
Thank you for your question. I guess the standard itself is more broad. It doesn't really target just one sector per se. So you definitely need to continue looking at your sector specific characteristics as you would normally expect. So through, for example, when you look at the PD side, through the appropriate approach on how to capture the risks and the features of the companies that operate in agri sector, but also on the LGD side to have an appropriate solution that help you with capturing the impact that you see in that sector.
Right. Thanks for that again. We have two more questions coming in. One, this is coming from an anonymous attendee. Would S&P's service include the review of a bank's existing approach to computing PDs and LGDs with recommendation for enhancing or improving those computations?
Okay, thank you so much for your question. At S&P Global level, we do have various capabilities in various sectors and various entities that target different types of services. So if you're interested in learning a little bit more about that, please let us know. I think we are distributing the presentation slides after this webinar, so you can reach out to us. Within S&P Global Market Intelligence Risk Solutions, we have readily available models, but we can have a further discussion with you if you're interested. So please do keep in touch with us.
And of course, we will be availing the slides from Ina's presentation to our participants. As I said, as we said from the outset, the presentation is also going to be available on our YouTube page, which is shared in the chat. I've also just shared a link for the S&P Global landing page where you can request an assessment, so you can find out more about their services. You can request a demo and discover more about S&P Global Market Intelligence's credit assessment scorecards. So that is also available. I think we have just one more question, and unless anybody else has anything else they want to speak on. You touched upon timing, Ina, of an economic turnaround and the resulting impact on lifetime PDs. Can you expand on that?
Sure. I guess it's one of those questions that are interesting. Lots of market participants globally, so not only within this group. So again, I'm not surprised that someone actually was interested in that. And indeed, the timing is quite important because it will impact your ECL calculation. So you need to regularly review scenarios that you use for your ECL calculations and proactively monitor the weights associated with different scenarios that you input in your model, especially in the light of COVID-19. There is different ways how you can reflect changing macroeconomic environment as part of the approach. So first is by revisiting the weights that you have internally associated with different scenarios. Second is reviewing the forecast itself. So without changing the weights, you just change the forecast. And third, you can revisit both the weights and the forecasts associated with different scenarios, depending on the view that you're taking, and that's why the timing of the review is so important.
Okay, I think we have one more question. It's actually in the chat. What have the general trends been on your models as it relates to IFRS 9 provisioning? If captured in the calculation, are you noting that the economic downturns as a result of the pandemic and or economic related assumptions on the model and their impact on the model being capped? So it's a long question. Do you want me to repeat it, or are you okay?
Yes, if you don't mind.
Yeah, that's not a problem. What have the general trends been on your models as it relates to IFRS 9 provisioning? And if captured in the calculation, are you noting that the economic downturns as a result of the pandemic and or the economic related assumptions on the model and the impact on the model being capped?
Okay. So yes, definitely. I definitely understand where you're coming from. The trends in the IFRS 9 calculation that are being reviewed by various market participants globally in general has to reflect those trends associated with pandemic. So definitely as part of our models, we do have a capability for the users to review those trends, to review their forecasts, the ways they review and the type of forecast data that they use in the tools obviously has to be entity specific, but we do see the trend to put a bit more weight to negative scenarios as expected. And as mentioned in various sources globally as a result of the pandemic. So various institutions have reviewed their forecast towards more downturn nature, so downturn view after pandemic. And depending obviously on the institutions that you rely your forecast on, they have different times for the bounce back, so for the recovery. And by using this information and by using this different views that you have on when the economy will bounce back, you will be able to capture the impact of it on your ECL calculations.
All right, Malaika, I hope that answered your question in full. And of course, as I said, we can always rely on INA for further dialogue going forward. We're nearly out of time. I do apologize once again to those of you who may have joined us a little bit late, thanks to the fact that we started early, so you actually joined on time. But we did have a number of people in the room who were under the impression that we were starting at 9 Eastern Caribbean or 9 Atlantic.